Imagine two companies selling the exact same product at the exact same price, earning the exact same profit every year. Yet, depending on the formula you use to evaluate them, one is a bargain and the other is a trap. Many investors begin their search for value with the price-to-earnings, or PE ratio, beta. Both generate 100 crore in profit annually. In the stock market, both companies carry a total valuation of 1,000 crore. Dividing that 1,000 crore market cap by the 100 crore profit gives both companies a PE ratio of 10. To a beginner, these investments look identical. The PE ratio focuses exclusively on equity. It treats a debt-free company exactly the same as one burdened by heavy loans, because it does not account for how the business is funded. Screening for stocks using only a low PE ratio often results in selecting financially fragile companies that only appear to be bargains on the surface. To see the true risk, we have to look at the cost of the entire business. Acquiring a business means taking ownership of its liabilities and its cash reserves. The true cost of the company extends beyond the price of the shares alone. Professionals measure this total cost using enterprise value, or EV. You take the market capitalization, add the total debt the company owes, and subtract its cash. Company Alpha's balance sheet shows a strong financial position. The company carries zero debt and maintains a cash reserve of 200 crore. Company Beta operates differently. It is heavily leveraged, carrying 800 crore in debt with only 50 crore in the bank. For Company Alpha, adding zero debt and subtracting 200 cash from the market cap gives a true cost of 800 crore. For Beta, adding 800 debt and subtracting 70 cash brings the cost to 1,750 crore. Even though the profits and stock prices are identical, the debt levels create a massive divide in what the businesses actually cost to own. To find the real value, we must compare this total cost against core operational earnings, removing the impact of taxes and financing decisions. We use EBITDA, earnings before interest, taxes, depreciation, and amortization. This provides a view of operating profit before accounting for how the company pays for its assets or its debt. In our scenario, both Company Alpha and Company Beta generate identical operating earnings of 150 crore. Dividing Alpha's enterprise value of 800 by its 150 crore operating profit gives us an EV to EBITDA multiple of 5.3. For Company Beta, we divide the 1,750 enterprise value by the same 150 crore in earnings. The multiple climbs to 11.7. When you look at the whole business, Alpha is the true bargain. Beta, which looked equally cheap through the lens of PE, is actually twice as expensive. A low stock price often reflects heavy leverage. When debt enters the equation, the reality of the valuation shifts completely. The danger of this hidden leverage becomes clear during an economic downturn. If external pressures cause operating profits for both companies to drop from 100 crore to 60 crore, the two businesses face very different futures. Company Alpha remains stable. With no debt obligations to service, it can use its shrinking profits to navigate the slump and wait for a recovery. Company Beta faces a crisis. It is legally obligated to make fixed interest payments regardless of its profit levels. Its remaining cash flow is immediately consumed by debt service. When fixed interest costs collide with falling profits, the equity value can vanish. The company is forced to prioritize its lenders over its shareholders. Compare these figures. A low PE ratio alongside a high EV to EBITDA multiple suggests current profits are supporting a heavy debt load. No single metric is perfect, but cross-checking valuation against the capital structure reveals the financial fragility that a single ratio can hide. Successful investors take ownership of the business in its entirety, accepting its risks and obligations in exchange for its future potential.